Let me go to the phones, 866-300-9298. Let me go to Jonathan. Jonathan calling us from Tennessee. Hey, Jonathan.
Hey, Dan. How are you this morning?
I'm good.
Hey, I have a question, and I'll hang up and listen from there.
Okay.
The difference between common stock and preferred stock.
Yes, sir.
Of course, I know that the preferred will pay a dividend, but can it move with the same volatility? Is there the same amount of risk as just a regular old stock that I'm not getting dividend on?
Yeah, good question, Jonathan. So, yeah, preferred stock, obviously, preferred stock is, there's guys out there that are going to cringe when I say this, but it's true. Preferred stocks are much more like a bond, okay? So preferred stock have a par value. Most of them are $25. And so that is the baseline. $25 would be the zero baseline. So that $25 and for that investment into a preferred stock, there's something what is similar to a coupon rate, and the coupon rate may be 9%. So at $25 a share, you're going to get 9% paid out whenever it is they pay out. And so, but the volatility on a preferred is not. So let me use an example. So a preferred stock of Ford Motor Company is not going. If Ford Motor Company is selling at $16 a share, and their preferred stock is at $25 a share, and Ford Motor stock goes down 10%, it is not likely that the preferred is going to drop down 10%. Will it drop? Does it track it a little bit? Yes. But the volatility, both on the upside and the downside. If Ford Motor goes up 30% in the rest of this year, their preferred is not going to go up 30%. Very, very unlikely that their preferred is going to go up 30%. It may go up a little bit. It may go up. I don't even know that it'll go up 15%, but it's not going to go up 30. So it doesn't track it. It'll track it in the sense that, yes, if it's up, chances are the preferred might be up a little bit. But here's the thing I want to stress about that. So the volatility, it's not as volatile. The swings aren't as great. But here's the thing I want to stress about that to everybody listening. If you own a preferred, just like a bond, in my opinion, you should not own it to try to make money on the rise in the price of the stock. That's not why you should own it. If that happens, that is great. But to me, if you're going to own preferred, you ought to own it for the return. In other words, for the growth that you get as a result of the income that it's paying. That's why you should own it. Don't own it because you think that, the $25 preferred that you bought for $24.50 is going to go to $35 over the course of the next 10 years. That's the wrong approach. That's not going to happen, and that's not why you should buy it. So that's the difference. That's why, to me, it's so much more like a bond. I tell people that own individual bonds. I'm not talking about bond mutual funds. Individual bonds, hey, look, if you're buying it because you're waiting for the bond to go up in value, or you're going to stress over the bond going down in value, it's the wrong reason to buy it. You're buying it to keep it because it's producing income. And you're buying it because you obviously need income. Because if you don't need income, don't buy the bond, buy a good stock instead. So if you're buying a bond, you're buying it because you need the income that is more consistent than income from anything else you're going to get. Right? Does that make sense? So that's why you're doing it. So great. That was a great question. I'm glad we had the opportunity to have a little coachable moment there.